Hello and welcome to Chapter 2, or Professional Standards. So in this chapter, we are going to spend the bulk of our time talking about the specific standards that auditors are required to follow when they're conducting an audit engagement. So if you think back to Chapter 1, we said that one of the things that distinguishes audit engagements from other attestation engagements is that auditors are required to follow specific rules when they conduct audit engagements. So that's what we're going to be talking about in this chapter, generally accepted auditing standards, or GAS as I'll refer to it throughout this lecture video. And then we're going to finish by discussing what a system of quality control is and what are the major components of a system of quality control that audit firms will follow. So, first thing that you guys need to know is, okay, who develops these auditing standards and what are these auditing standards called? So, historically, accounting has been a self-regulated discipline, and that has changed, obviously, in the last decade. So, historically, the Auditing Standards Board set the auditing standards. So the Auditing Standards Board within the AICPA set these standards. And from 1939, these were called the Statements on Auditing Procedure. In 1972, they were revised to be called the Statements on Auditing Standards, or the SASs, and this is still what they are called. Obviously, with the advent of the PCAOB, there was a need for them to set their own standards for publicly traded companies, and these standards are called the auditing standards, or the ASs. So in the United States, we really have two groups: the Auditing Standards Board and the PCAOB. The Auditing Standards Board sets the statements on auditing standards, and the PCAOB sets the auditing standards. The other important thing for you guys to note is who, when they do set these standards, who does it apply to? So for the AICPA, the AS, or the SASs, apply to both public entities and to non-public entities. They relate primarily to non-public entities. So any firm that does not issue financial statements through some kind of stock exchange, their standards technically relate to public entities, because when the PCAOB was created, instead of starting from scratch, they basically adopted what the AICPA already had, and these were called interim standards. And basically, if you read through the PCAOB standards, they say, well, unless we specifically supersede something or come up with a new standard that relates to a specific thing, then we're just going to rely on these AICPA standards. So the AICPA SASs technically do relate to audits of public entities, but for the purposes of this class, for the purposes of the CPA exam, you should assume that if we're talking about a non-public entity, we're relying on the SASs. If we're talking about a public entity, we're dealing with the PCAOB auditing standards. So again, for public entities, anything that the PCAOB issues is going to relate to public entities. Now, this dichotomy is further complicated by the fact that different states have now ruled throughout court systems that as an auditor, you may actually be required to look at both. So that's a separate legal discussion that we have in the graduate audit course. But for example, in California, they have ruled that it's not good enough that you just follow the AICPA SASs. If the PCAOB has stricter, tougher guidelines, you should be following what the PCAOB says. And so this is working its way through courts, and so it's kind of difficult to discuss in a lot of depth. But just understand that the lines aren't as clear as they appear on this table. But again, for the purposes of this, what do I want you guys to know? Who are the major players? The Auditing Standards Board and the PCAOB What are the names of the standards, the statements on auditing standards, and the auditing standards, and who they relate to. So non-public and public companies. Okay, so generally accepted auditing standards, or GAAS, as again I'll refer throughout this slideshow. These identify necessary qualifications and characteristics of auditors, and in addition to that, they guide what the auditor should be doing throughout their audit. The purpose of GAAS is to achieve the following objectives within an audit examination. First, we need to be able to obtain reasonable assurance about whether the financial statements are free of material misstatements. So that's a very loaded sentence, right? So first, reasonable assurance. We're not saying absolute assurance. We're just saying reasonable. So what would a reasonable person who reads the financial statements think in terms of what is important, what is not? And also whether they're free of material misstatements. Notice we're not saying all misstatements, just those misstatements that would be material. And materiality for this purpose is similar to what you guys have discussed in your financial accounting classes. What would be material to a reasonable user of the financial statements? And then ultimately, as we discussed in Chapter 1, we need to be able to report this and communicate this. We need to be able to communicate our findings. And so there's specific requirements of what needs to be in our report. So the components of GAAS, there's really kind of 3 tiers or 3 layers. First, we have these fundamental principles. Okay, these guide the general conduct of the audit. They are not specific at all. They're very general in terms of what the auditor needs to consider, what the auditor needs to do. Then we have those very specific guidelines, the PCAOB auditing standards and the ASB statements on auditing standards. These are the requirements that are going to help you support those fundamental principles. And then ultimately, we have the most detailed guidance, which are those interpretive publications, which provide guidance on the specific application of generally accepted auditing standards. So let's look at these. So what I'm going to show you right now are tables that compare the old standards to the new revised principles. And this is done not to confuse you. It's done because I want to show you what has changed and really more than anything show you how they're very similar. They're very similar. The old standards to the new principles are very similar. So in terms of testing, what do I want you guys to know? I want you guys to focus on the principles. So we're going to start with the responsibilities principle, and we're gonna move on. So focus on the principles as opposed to on the left-hand side. You'll see these general standards. I'm not concerned that you guys know those. So these are here for just so I can demonstrate similarities and differences between the two. So if we start over here and we talk about responsibilities, auditors are responsible for the following. They need to exercise competence and capabilities. So you need to have people who are conducting audits who are competent, which means that they have the necessary educational requirements and that they understand what they're doing. They have been adequately trained to perform an audit. This obviously relates to the old general standard for adequate technical training and proficiency. So these are just worded differently, but it's looking at the exact same thing. Are you adequately trained, and are you proficient in accounting, and therefore able to actually perform an audit? The old standard said you need to have independence and mental attitude, and this has been replaced by what are called the ethical requirements, which have 2 components, an independence requirement and a due care requirement. With regard to independence, and we'll talk about this later, independence has 2 components. There's independence in fact and independence in appearance. And again, we'll talk about this here in a minute. But due care relates to, are you performing your job in a manner that is consistent with what a reasonably prudent CPA would do in similar circumstances? So this has been beefed up a little bit in terms of requiring them both. But if you look over here, you say, we already had both of these, right? We have independence and mental attitude, and we had due professional care. Those are both captured here in the second bullet point. And instead of calling it independence and due professional care, they just call it relevant ethical requirements. And so they have expounded on it a little bit from what the old standards were, but ultimately this second bullet point is reflecting 2 and 3 over here on the left hand side. What has been added that was not there before was professional skepticism and professional judgment. And if you remember back to chapter 1, professional skepticism is this idea that we need to maintain a questioning mind, that we need to be skeptical of evidence that we collect and not just accept things at face value. This was always implied or inferred, and so what the AICPA has done by including this specifically is they've just made what was always implicit explicit in the standards, that you need to exercise professional skepticism and appropriate professional judgment. So by and large, what they had before is exactly what we have now. It's just laid out slightly different. Now, in terms of performance, what they now call the performance principle used to be called the standards of fieldwork. So let's talk about how these kind of relate. So the first thing in terms of the performance principle is the auditors need to obtain, again, reasonable assurance that they have adequately planned work and supervised assistance. If we look at the old standards, planning and supervision, same exact thing. And so this goes back to our definition of auditing, that it's systematic. You're not just winging it. You're not just going out there without a plan. You need to have the audit planned, and part of that planning process involves making sure that subordinates are adequately supervised and their work is being evaluated as though they are subordinates. Then as we go down, it says determine and apply appropriate materiality levels. And this relates somewhat to the idea of reasonable assurance, but materiality is an important concept. This idea that we're not concerned with everything that could possibly be wrong with the financial statements, only those matters which are material. And we'll talk more about what materiality means specifically, but we need to consider what a reasonable user of the financial statements would consider to be important. And so these are anything that on either a quantitative basis, so in terms of a dollar value, or a qualitative basis, a reasonable user of the financial statements would consider to be important. Again, materiality was always just kind of assumed or implied, and so all they've done is they've made it very explicit that you need to first determine what would be material, and then make sure as you're going through and you're doing your audit work that you're applying that materiality to everything that you're doing in terms of evaluating exactly what you find. Notice though that this is not over here. Materiality is not addressed by these old standards. So this is a departure from what was occurring before. Next, it says identify and assess the risk of material misstatement. So, the risk of material misstatement is the assessment of an entity's control risk, so how good are the entity's internal controls, as well as inherent risks within the entity. So, inherent risks are risks that an account balance or type of transaction may be recorded improperly without regard to the controls that are in place. So some accounts are inherently riskier than other accounts. So for example, cash is going to be more inherently risky than accumulated depreciation. hopefully for obvious reasons. And so to assess the risk of material misstatement, you need to first understand what's going on within the entity. What kind of company are you auditing? Then you have to understand the environment in which that entity operates. So, for example, if I'm auditing Google, I need to understand how other tech companies operate and what are the risks involved in that specific industry. And then I need to assess the risk of material misstatement. So if you look at this third bullet point over here, identify and assess the risk of material misstatement, it's just a different way of saying two over here. We need to understand what's going on within the entity. We need to understand the environment or the industry in which it operates and assess the risk of material misstatement. So these are directly linked to each other. And then lastly, and maybe most importantly in the performance, we need to obtain what is called sufficient appropriate evidence. So sufficient relating to the quantity and appropriate dealing with the quality of the evidence. And we need to obtain specifically enough sufficient appropriate evidence to support our ultimate opinion on the financial statements. So what you see here is this is basically the same the performance principles are the same old standards of field work with a discussion about materiality. That's really the big departure or difference between what we had before and what we have now. And then lastly, we have these reporting requirements. And the two big reporting requirements are, first, we either need to express an opinion or say that we cannot express an opinion, and we'll talk about what that means here in a minute. And the second, as part of that opinion, we need to say, are the financial statements based on GAAP? Are they in conformity with GAAP or whatever applicable financial reporting framework that we're using? There are other comprehensive bases of accounting, but in this case, we are going to just use GAAP just to make it simpler. So if we look back over here, financial statements are in accordance with GAAP. That's dealing with the second bullet point. Express an opinion or disclaim an opinion. That's dealing with the first. Disclaiming an opinion basically means that you're not going to express an opinion. You're going to say, we cannot express an opinion. That's what it means to have a disclaimer of an opinion. So 1 is dealing with the second bullet point, 4 is dealing with the first. And if we look at 2 and 3, these are dealing with issues within financial statements. So we could run into the situation where GAAP is not consistently applied, and here it says only report if it's not consistent, and adequacy of disclosures, only report if they're not adequate. These were what were called implicit standards, which means basically we were silent on them unless there was an issue, and that's still the case. So under the principles, they just did not include them, but they are still implicit. So if there is an issue with consistency, we need to address that in the report. And if disclosures are not adequate, we need to address that in the report. And we will talk more about those kind of issues when we get to Chapter 12, which is specifically the audit report. But again, what you notice by going through all of these is that there's a lot that is the same. They've reworded it, and sometimes these accounting groups do these kind of things just to make sure that they look like they are out there doing something. But the old things and the new things are pretty much the same. They're just worded differently. What do I want you guys to know? I want you guys to know the responsibility principles. I want you guys to know the performance principles, and I want you guys to know the reporting principles in terms of for the exam. Now, if we think about an engagement and when are things happening and when are different rules applicable, this is a good kind of summary of, what are the different steps in conducting an audit and these different principles. So in terms of just the timeline of conducting an audit, the first thing we need to do is get a client. From there, we need to plan, because again, this is a systematic process. We're then going to do a risk assessment. So say, okay, what are the risks to this entity? And that's again dealing with that, assessing the risk of material misstatement. We're then going to go out and collect some kind of audit evidence, and ultimately we're going to report. So when we say, okay, well, when are each of these principles applicable? And the responsibilities are applicable throughout the entire engagement, all the way from obtaining a client, because if you think about it, you need to make sure before you obtain a client that you are competent to be able to do an audit for that kind of an entity. And you have to assess, am I independent with respect to this entity? If you own a bunch of shares of stock in that company, you cannot obtain them as a client to audit them. So responsibilities are relevant throughout, from the beginning to the very end. So we need to make sure that we're independent, not just at the beginning, but all throughout the audit as well as at the end. But we also need to make sure that we're exercising due care as we're doing the audit process. We need to make sure that we're doing an adequate job of risk assessment and collecting enough evidence, and then ultimately reporting. In terms of the performance principle, which are those things like obtaining sufficient appropriate evidence, those are only applicable during the actual fieldwork phase of the audit. So when we're actually planning, doing, say, analytical procedures, doing our risk assessment procedures, and obviously when we're collecting audit evidence. And the reporting standards obviously only relate to the reporting, because the reporting standards deal specifically with what needs to be in the audit report. Since we're not going to even be considering the audit report until the very end, the reporting principles only apply to the reporting portion. Okay, so let's go into each of these in a little bit more depth. So again, first starting with the responsibilities, competence and capabilities. We need to make sure that we have the appropriate levels of experience to audit the company, as well as the expertise. Some industries are much more complex to audit than others, and they all have their own specific accounting and their own specific risks. We need to make sure that we feel that we have the adequate technical knowledge and expertise before we accept an audit engagement. Once we've accepted an audit engagement and we start working, we need to have the technical knowledge at that point. So what do I mean by that? What I mean is, you can say I've never audited a financial institution. I can agree to audit a financial institution provided that I obtain the requisite expertise to audit that kind of a company before I start doing the procedures. I cannot be gaining experience as I go. Okay, from as soon as I start actually doing any of the work, I need to have the expertise in place. So competence and capabilities is a real critical assessment that we need to make before we accept clients. It's something we need to really think in terms of our acceptance of new clients. Independence, as I said before, absolutely critical. We are information intermediaries who are trying to reduce information risk. If we are not independent, we no longer provide any value. Because if we're just working with management, then the people that are going to be getting the financial statements are going to say, well, why don't we just have management give us the financial statements, and we could have saved ourselves a lot of money. In order to be independent, we need to be independent both in fact and in appearance. So in fact is dealing with our actual objective state of mind, and are we actually in fact independent. It also relates to the technical correctness of whether we are independent. So for example, one of the things we say in terms of being independent for an auditor is that you can have no direct financial relationship or material indirect. So a direct financial relationship would be owning shares of stock. You cannot own shares of stock in a company, so you can have no direct financial interest, but you can also not have a material indirect financial relationship. So the most obvious example of an indirect financial relationship is a mutual fund. So if 40% of my net worth is some mutual fund that relies heavily on a client, then similarly, I'm not independent with respect to that entity. So independent, in fact, is saying, are you in fact actually independent? And that's both in terms of what is the technical correct definition of being independent, as well as the objectivity of your state of mind as you actually conduct your affairs. Independence in appearance deals with other people's perception of your independence. So if others do not believe that you're independent, you're not independent. If there's a general consensus that you have relationships with management, for example, you're not independent. So we need to consider all financial relationships we have with the client, including other services we perform, as well as managerial relationships. And this gets really complicated to even considering, okay, are there former employees of our audit firm who are now working for the client? And so this is a topic that we address in depth in the graduate course of exactly, okay, what are our professional responsibilities as auditors with regard to independence? Due care. Again, this, you guys have heard this before in your law classes. Due care is that level of care or that level of performance that a reasonable, in this case, auditor would do in similar circumstances. So if other auditors examine 30 transactions when they look at a specific control, you should probably be examining 30 transactions. If other auditors consider materiality to be 5%, you probably should not be using 50% as being material. So these are all considerations that we have to make as we perform the audit and everything we do. What would another reasonably prudent CPA do in similar circumstances? And so you should not depart from norms within either the industry or practices as you conduct your professional responsibilities. And then lastly is professional skepticism, and we talked about this in chapter 1. But again, making sure that we have an appropriate questioning critical mind and making sure that we are applying judgment based on all of our training, knowledge, and experience, and making informed decisions throughout the audit. We need to be exercising appropriate professional skepticism and appropriate judgment and documenting both throughout the audit. So it shouldn't be a question of how exactly you arrived at a given judgment. It should be documented very specifically. These are all the things that we considered. This is why we went with this decision or this judgment. This is how we arrived at this judgment. These are the steps that we took. There shouldn't be big leaps of inductive logic of how you got to your conclusion. You need to make sure and adequately document exactly how you assess evidence, so how skeptical you were with regard to evidence, things that you considered with regard to the veracity of evidence or the persuasiveness of evidence, and then more importantly, when you reached a conclusion about something, how did you arrive at that conclusion? So that is the responsibilities. Next is the performance principle. And so for the performance principle, we have 4 things that we need to consider: the planning and supervision, the materiality risk assessment, and audit evidence. So for planning and supervision, we need to make sure maybe most importantly from this is prepare an audit plan. So that's a written program of exactly how we're going to conduct the audit, what we're going to do in each phase, and how we're going to ultimately get the audit completed. But another thing that we need to make sure to do is we need to document exactly how we went about assessing the work of subordinates. So we need to make sure that we're adequately supervising subordinates so that work that they do does not just end up in the audit working papers. It's been evaluated at several different levels. So typically how you see this work, a subordinate, say a staff auditor, will do some work. They will ultimately need to get approval of the audit senior to say, okay, yeah, this seems reasonable. And so it's been supervised by the senior. Then it will go up to the manager. The manager will say, oh, well, the senior didn't think about this. You need to fix this, and this. Subordinate fixes it, sends it back up to the manager. Maybe it eventually gets by the manager, then it goes to the senior manager, and the whole time the working paper is getting bounced back and forth, and it's getting reviewed again and again and again. But again, this is providing assurance that everyone that is above that subordinate has been able to review and agrees with the conclusions that were reached by the subordinate. We do not want subordinates just out there doing working papers one time and then they end up in the audit working paper files. That's not adequate supervision. So we need to have a plan, and then we need to make sure that as we're going through the plan that every working paper is being adequately reviewed by someone. And it's typically going to go in a hierarchical structure from that person's immediate supervisor on up until we get to the audit partners. We also have to consider materiality. So anything that would influence the decisions of a reasonable user of the financial statements is considered material. So both quantitative aspects as well as quantitative aspects. So if something's a high dollar value, that seems pretty obvious that would be quantitatively material. But similarly, if something's got a small quantitative value, say someone stole $5, you say, well, that's not material. Well, if it was the company CEO, then now maybe it is material, because now there's some integrity issues that we need to consider. So we need to consider both, and we also need to consider it throughout the audit. So we're not just going to say, okay, we're only going to think about it at the beginning and the end. As we're collecting evidence, we need to say, okay, this is off, but why is it off? So, for example, if we find an error of $100, we probably say, okay, that's not material. But if we find a fraud of $100, now maybe that is material. So the nature of the discrepancy, where it actually comes from, who actually perpetrated something, all those things are going to be considerations in terms of what is material and what is not material to the financial statements. Risk assessment, again, is understanding what are the risks for this specific company given the industry that they operate and the business environment in which they operate. And so we need to make sure and understand the entity, including its internal control structure, to see how where the risks are and where we need to spend more time, where we need to spend less time. And this is important because it's going to determine the effectiveness of the substantive tests that we're going to perform. So substantive tests are tests that we perform to substantiate an account balance or type of transaction. And when we think about all of the evidence that we collect, we can kind of throw it into two general pools. We can say we need to obtain evidence about controls and we need to obtain substantive evidence. Well, they're complements to each other. So if we feel really good about controls, then we don't have to do as much substantive. If we feel really good about substantive, we don't need to do as much work on controls. And so understanding the entity, including its internal controls, is going to affect the substantive tests that we actually perform. Because if we go through and we look at the entity's internal controls and we say, man, these are terrible, there's no way these controls are going to prevent or detect any kind of error or fraud, then we're going to have to do more substantive tests. But similarly, if the entity's internal controls are magnificent and we say, wow, these are great, these would capture pretty much any kind of material error or fraud, then we can perform less substantive tests. So they affect each other. And then we're obviously going to want to do this assessment before we determine what kind of audit evidence we're going to collect. And we need to make sure that we have both sufficient and appropriate evidence on which to base our opinion on the financial statements. So again, sufficiency is saying, okay, what is the quantity of evidence? How many transactions do we need to look at? What components do we need to look at? And appropriateness is dealing with the quality. And when we talk about the quality of evidence, we need to consider both the reliability of the information as well as the relevance of the information. So it's no different than any other kind of accounting information. There's both relevance and reliability, and they're complements to each other, and oftentimes, as we see with other kinds of accounting information, they trade off with each other. So what I mean by that is information that tends to be reliable isn't always the most relevant. So for example, historic cost accounting is very reliable. It's not always the most relevant information. And similarly, information that is very relevant isn't always very reliable. So when we think about fair value accounting, sometimes that information is very relevant and important and useful, but it's not always the most reliable. So in terms of appropriateness, we need to consider both the relevance and the reliability of the evidence that we're collecting. So when we think about evidence overall, it's dealing with detection risk, and we'll talk more about detection risk when we get to chapter 4, which is dealing with the audit risk model. And detection risk is one of the 4 components of the audit risk model. But detection risk is just the risk that we will not detect a material misstatement with our procedures. That's all it is. What is the risk that we're not going to detect something if we follow our audit plan the way that we should? And obviously 2 parts of this is the appropriateness of the evidence as well as the sufficiency of the evidence. The relevance and reliability, as I just discussed, are the 2 major components of what makes evidence quality or is the appropriateness. So again, relevance dealing with, what does the evidence tell the auditor, and reliability is, can we trust the evidence? And sufficiency obviously dealing with the quantity of evidence, how much evidence are we going to collect? Again, just because something is reliable does not mean that it's better evidence than something that would be relevant. And similarly, just because something is relevant evidence does not mean that it's better than information that would be more reliable. We need to use our professional judgment to say what would be the best evidence. And there, like I said, there's always a trade-off between relevance and reliability, and we need to consider both in terms of saying, okay, what is the appropriate level of evidence? So again, sufficiency is saying what is the quantity of transactions or different things that we examine, and it's obviously influenced by the effectiveness of the entity's internal controls, as I discussed earlier. If we have good controls, so this is what this is illustrating, if we have effective internal controls, and therefore a lower level of control risk, controls are less risky, we don't need to look at as much evidence. And hopefully that's obvious to you guys why that is. And the reason is because if we think about internal controls are policies and procedures that are in place to detect material errors and fraud. So the more effective the entity is at detecting its own errors and fraud, the less effective we need to be at detecting errors and fraud. Conversely, if the client's internal control system is ineffective, we're going to have higher control risks. So controls are risky. There's less likely that they're going to detect errors and fraud. And in that case, we're not going to be able to rely on the client to catch everything. So we're going to have to evaluate more evidence so that we can possibly find any kind of errors or fraud that could be in there. Again, appropriate. We're talking about relevance and reliability. Relevance, again, does the evidence address the specific assertion that we're interested in? So if we think about, say, an asset account, a very relevant assertion is existence or overstatement. We want to make sure that when we collect evidence, we address that assertion. We want to make sure that they're not recording assets that do not exist. Reliability, we're looking at the source of evidence. Where does it come from? And there's a spectrum from more reliable to less reliable. So starting with more reliable, the most reliable source of evidence would be the auditor's direct personnel knowledge. And so these would be things that we've actually done ourselves. So for example, we go out and do an inventory observation. So we actually go out and count inventory. That's really good, reliable evidence. How do we know it's reliable evidence? Because we did it. You can't really get much better than what we've done ourselves. The next level would be external documentary evidence. So if we get, say, a confirmation back from a customer, that's someone outside of the company sending us information about the company. If we get a bank statement directly from the firm's bank, that's external documentary evidence. That's going to be also very reliable. Why do we think it's more reliable? Well, we think it's more reliable because the client's bank is unlikely to have a motivation to lie on behalf of the client. Then we say, okay, then we have internal documentary evidence. So that those would be those documents that we get directly from within the client. So their own sales invoices, their own shipping documents, their own receiving reports. And then the lowest source of evidence in terms of reliability would be, and it's not listed here, would be responses to inquiry. So whether they are verbal or written responses to inquiry, that would be the lowest. So in terms of the appropriateness of evidence and how it relates to controls, if controls are effective and we have lower control risk, we can use less effective substantive procedures. If they're ineffective controls, we're going to have higher control risk and we're going to have to use more effective substantive procedures. So how does this relate to what we just discussed? And you say, well, if we're deciding on more or less effective substantive procedures, we're going to have to consider what evidence those procedures can give us. So certain procedures provide much more relevant information and others provide much more reliable information. So, for example, if we are worried about the overstatement of assets and specifically accounts receivable, one of the procedures that we can do is we can send off accounts receivable confirmations, and we will send basically a statement to a sample of the balances that make up accounts receivable to the client's customers and say, hey, is this exactly how much money you owed at the balance sheet date? That gives us very good evidence, right? It's relevant It's dealing with an assertion that we're very concerned about, existence. It also gives us evidence on rights and obligations. It also gives us evidence on the valuation. So it's addressing several important assertions related to accounts receivable, and it's also great in terms of reliability. It's external documentary evidence. So it's very appropriate evidence regarding accounts receivable. In fact, it's such great evidence that it's actually a required procedure when we're talking about accounts receivable. Now, what's the problem with that? Well, why wouldn't we just always do all these procedures? And the reason is we're a business. If we're doing auditing, we're a business, we need to make money. And while accounts receivable confirmations provide us with a lot of good evidence, they also cost a lot of money to actually perform the procedures. There's a number of complications that arise when we do accounts receivable confirmations. So effective substantive procedures tend to be much more expensive to the auditor to conduct. When we use effective substantive procedures that are costly, that means our profit goes down. So we would like to use less effective substantive procedures. That's going to be easier to do if the clients have better internal controls. But these are the considerations that we have to make when we're deciding what evidence to collect. It's not just, what evidence can we get? It's also what evidence do we need to get given the client that we're dealing with. And all of these things are related. The client that you're auditing is going to influence the evidence that you need to collect, as well as your risk propensity and a number of other issues. But these are not done separate and apart. They're considered together. So that is all that we have for the performance principle. So again, responsibilities, performance, and the last one was reporting. So let's talk about the reporting. There's really just two things, right? We need to express an opinion or say that we cannot express an opinion, and then we need to assess whether the financial statements are in accordance with an applicable framework. So expressing an opinion is pretty obvious. We're going to, at the end of the auditor's report, we're going to express an opinion. And we're either going to say the financial statements are in conformity with GAAP or they're not in conformity with GAAP. And so these two go hand in hand, right? Part of expressing an opinion is whether the financial statements are GAAP. So we need to make sure and look at the criteria used to make sure that an entity is actually complying with these different applicable financial reporting frameworks, and then specifically say whether the financial statements are in accordance with that. And GAAP is not the only one. IFRS obviously is there, but there are other special purpose frameworks. There's cash accounting, there's tax accounting, there are other comprehensive bases of accounting that we can express an opinion on. GAAP, for the purposes of this class, we're going to generally assume that we're doing a GAAP audit. And so let's look at one of these auditor's reports, and this will probably help you guys understand what we're talking about a little bit better. So that we're going to go through the whole report, not just the opinion part. So first we're going to have, there's several different important parts. One is the title. So we're going to have the report title, Report of an Independent Registered Public Accounting Firm. This is an auditor's report for a publicly traded company, and specifically they're registered with the PCAOB. The addressee is typically the shareholders and the board of directors. And then we're going to have what's called an introductory paragraph. In the introductory paragraph, you're just going to basically say what you've done. So in this case, we have audited the accompanying financial statements of McDonald's. Our responsibility is to express an opinion on these financial statements based on the work that we've done. They're then going to go for a publicly traded company and talk about the scope of the audit, which is exactly what they did. So we conducted our audits in accordance with the standards of the PCAOB. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatements. So again, they're talking about planning and performing and reasonable assurance. An audit includes examining on a test basis evidence supporting the amounts and disclosures in the financial statements. An audit also includes assessing the accounting principles used and significant estimates made by management, as well as evaluating the overall financial statement presentation, so those presentation disclosure issues. We believe that our audits provide a reasonable basis for our opinion. So again, they believe that their audits provide a reasonable basis because they have obtained sufficient appropriate evidence to support the different amounts that are shown in the financial statements. And then finally we get to the opinion. So in this case, they're expressing their opinion. In our opinion, the financial statements referred to above present fairly in all material respects, and that's really important. They're not saying that they're exactly right. They're saying materially they're correct. In all material respects, the financial position of McDonald's in conformity with U.S. GAAP. So it's very specific. This is what our opinion is, that the financial statements present fairly, and specifically, what do they present fairly? What is the applicable framework in this case? U.S. GAAP. As we've discussed, it can be other things. Also, as part of AS5, they're required to look at internal controls and assess those as well. So this is just a reference to their internal control audit. And then ultimately it's going to be signed by the accounting firm and dated. So again, what are some of the major components? The auditor's and management's responsibility in the financial reporting process. If you go back again to the intro, it says that these financial statements are the responsibility of the company's management. So if you remember back, why is that important? Well, if we think back to what an attestation engagement is, we say, well, an attestation engagement is where an independent party assesses an assertion or subject matter that is the responsibility of another party. So it's very important to make sure and delineate that we didn't come up with these financial statements, the company's management did, and now we're just assessing those financial statements. So that goes back to what we talked about in chapter 1. So again, we need to make sure and say what management is responsible for, what we are responsible for, specifically expressing an opinion on the financial statements, that we audited in accordance with the PCAOB standards. If we're doing a publicly traded company, we would reference the auditing standards generally accepted in the United States of America if we were looking at a private entity under the Auditing Standards Board. And then ultimately the opinion. That's the big part of the auditor's report. That's the most important thing. That's all anyone's really concerned with. What is your opinion on the financial statements in terms of their conformity with GAAP? If we're talking about a publicly traded company, we also need to discuss the audit of internal control over financial reporting. So what are the different types of opinions that an auditor can issue? I'm not going to spend a lot of time talking about these because chapter 12 is entirely devoted to the audit report. So it doesn't really make a lot of sense to spend too much time talking about it now, but it is worth mentioning. So we have 4 different general types of audit opinions that we can have. An unmodified, also called an unqualified opinion, those terms are used synonymously. And in an unmodified or unqualified opinion, they're saying the financial statements are in conformity with GAAP. That's exactly what we just saw. They're saying, yeah, in all material respects, the financial statements fairly present in conformity with GAAP. That's the typical standard audit opinion. Then we have what are called qualified opinion. And a qualified opinion are also called except for opinions, or you'll hear them referred to as except for opinions. Here what we're saying is, except for, say, one thing, like leases, except for their note about leases, the financial statements and notes are GAAP. It's just that their lease footnote is off for some reason. And so this is for a very specific item that can be isolated. An adverse opinion is dealing specifically with issues related to GAAP. And here what we're saying is the financial statements are not in conformity with GAAP. And then lastly, we have what are called a disclaimer of an opinion, which is where an auditor does not express an opinion on the financial statements. So remember, if we think back to the reporting principle, it says either express an opinion or say that an opinion cannot be expressed. When they say an opinion cannot be expressed, they're referring to a disclaimer of opinion. And then lastly, the role of a system of quality control and monitoring efforts to meet appropriate professional quality. So, a system of quality control. This is going to provide a firm with reasonable assurance that the firm and its personnel are conducting audits at the highest quality level. And this is done to comply with both professional standards and regulatory legal requirements. So auditors are going to be evaluated either by at some state level or at the federal level if we're talking about the PCAOB, in terms of, what are all of the policies and procedures they have in place to make sure that they're conducting audits that other reasonably prudent CPAs would be providing. And we're going to it's going to also make sure that we issue reports that are appropriate in given circumstances. So there's a number of elements of quality control. The first one, and probably the most important, is tone at the top, also called leadership responsibilities. And in this section, we want to make sure that the leadership of the firm is stressing the importance of doing quality engagements, not cutting corners, following all the procedures that are in place, complying with all of the relevant professional and ethical requirements. If the people at the top of the firm are putting forth the idea that it's okay to cut corners, then certainly at the staff level they're going to think that it's appropriate to do that. So leadership responsibilities is critical, or is critically important. Relevant ethical requirements. So the two big relevant ethical requirements, if we think about audits, are independence and due care. We need to make sure that we are independent with respect to all of the entities that we audit. And we also need to make sure that we're exercising due care. So we need to make sure and understand what would a reasonably prudent CPA do in auditing a financial services firm, and make sure that we are doing all of those procedures and auditing in accordance with what other auditors who audit similar entities are doing. And that relates, again, that dovetails nicely into this idea of acceptance and continuance of clients and their relationships for specific engagements. We need to have policies and procedures in place that specifically spell out what clients are we going to accept and what clients are we not going to go after. And once we do have a client, when are we going to consider maybe leaving a client? And there are a lot of good reasons to leave a client. Clients that are about to fail, we probably don't want to be associated with them, because anytime a client fails, we're likely to be sued as a result. And so we need to have very specific policies and procedures in place to make sure that we're accepting the right kind of clients, that we have both the personnel to be able to adequately address their needs, and that we have the appropriate expertise and mix of personnel to be able to perform the engagement. These are all considerations that we need to consider with all of our clients. What is the lifespan of a client from acceptance to maybe moving on to and dropping a client? We need to have policies and procedures in place that spell out exactly how we're going to handle that. Human resources. Human resources involve everything from what are the policies and procedures for hiring people to promoting people once they're within the firm, and then ultimately, when are we going to, just like with clients, when are we going to fire people? So everything from hiring, promotion to termination. So we need to have policies and procedures in place to make sure that we're hiring people that have the technical training and competence to do the audit. We need to have policies and procedures in place of, okay, when does someone become a senior staff associate? When do they become a manager? When do they become a senior manager? When are they going to be up for possible promotion to partner? And similarly, we need to have very specific procedures in place for when do we need to get rid of people. When someone does something, when does it rise to the level of an offense where we can terminate their employment? Engagement performance are those policies and procedures of exactly how are we going to conduct all of our audits. What are the procedures in place for the actual conduct of the audit? And then lastly, monitoring. So it's not just enough to have an appropriate tone at the top, consider ethical requirements, and have these different policies and procedures in place from 1 through 5, and then just call it a day and walk away. We also need to have an independent system where we are going back through and we're saying, okay, we say that we have these engagement performance procedures, but are the staff actually following them? We have these policies and procedures for hiring new people. Is HR really following them? We have these procedures in place for what clients are we going to accept. Is the partners following this guidance of what kind of different client firms are we going to accept as potential clients? So all of these first 5, we need to monitor our performance in each of these areas and go back and make sure that we're fixing things that aren't working the way that they're supposed to be working. So for example, if we have a great tone at the top and it's really what we want it to be, but for some reason we're hiring or we're accepting clients that don't necessarily fit with our tone at the top message, then maybe we need to either go back and address what we're saying as far as tone at the top to fit our current clients, or we need to make sure that we're strictly enforcing this acceptance policy so that it's compliance with the tone at the top. And similarly, if we have this great tone at the top, but what we're doing in terms of actual performance on the engagement is not of sufficient quality, then we need to say, okay, we need to make sure that this engagement performance, these engagement performance procedures are, in line with the tone at the top that we're trying to set. So these all work together, but ultimately we need to make sure and go back and monitor them to make sure that they're actually being implemented and followed as we think that they should be. For publicly traded companies, or specifically firms that audit publicly traded companies, there's a very specific process that the PCAOB goes through in terms of their inspections of those companies. So for an audit firm that audits more than 100 public entities, they're going to be audited every year. So KPMG and Deloitte and Pricewaterhouse, they're audited or they're inspected by the PCAOB every year. For those smaller firms that also audit public entities, it's going to be every 3 years that they're going to be inspected for their quality control procedures. And these inspection reports, you can look at them if you'd like at the PCAOB.org website, and they're going to discuss specifically, what deficiencies the PCOB inspection team noted in terms of the audits, say planning or the evaluation of evidence and the different influence that the deficiencies could have on the ultimate opinion that the auditor issued. So this is for publicly traded entities, but states have inspections as well. So all firms at some level are going to be required to be involved in some kind of quality control mechanism. At the publicly traded firm level, it's done by the PCOB, but all audit firms are required to be adhering to a system of quality control and to be peer reviewed, either by other audit firms or a specific agency or entity. So that's it for Chapter 2. Make sure and look for the Chapter 2 homework explanation video. And again, if you guys have any questions, make sure and contact me or post your questions to the discussion board.